How is everyone doing? Welcome back to another episode of The Banker Next Door. I'm your host, Dr. Joe Berquist. Today, we're going to be talking about the rise of shadow banking and why small businesses choose a non-bank lender. And, both these things surprisingly go hand in hand. So I saw two blog posts from PCBB, which I'm going to bring up now, which I want to share with everybody. I think people will find very interesting. So this first one is called The Rise and Risks of Shadow Banking. So overview of shadow banking here. So shadow banking activity involves credit and lending outside of traditional banks by non-regulated institutions without access to funds from central banks or credit guarantees. Shadow banking's popularity has risen substantially in recent years as organizations such as hedge funds, private equity funds, mortgage lenders, and buy now, pay later companies have stepped up their lending activity to individuals and businesses unable to access capital through traditional banking channels. Shadow banking has become a major piece of the pie. According to the Financial Stability Board, shadow banking activity now represents $250 trillion, approximately 49% of global financial assets. The banking industry is intricately involved as well, with traditional banks having loaned more than 1.2 trillion to the shadow banking sector, according to the Federal Reserve. In fact, data from Fitch Ratings shows that lending from banks to shadow banks was up 20% year over year as of March 31st, 2025, compared to commercial lending for the same period, which was up only 1.5%. Now, you might be asking yourself, well, why are banks lending to quote unquote shadow banks? Well, shadow banks can encompass a lot of things. They can encompass hedge funds, private equity funds, mortgage lenders, buy now, pay later. And why is that? Well, a bank may provide, so think of a mortgage company, right? So you've got a residential mortgage operation. Well, how do you fund your loans? Well, they're most likely, for the most part, they've set up what's called a warehouse line of credit with a much larger bank, say like Bank of America. So they go to Bank of America and they say, hey, Mr. Bank of America, we need a line of credit to fund our loans to our customers. And so what they do is they get a $50 million line of credit in place with Wells Fargo, or with Bank of America rather, based on their loan volume. And they basically say, okay, so then they go out and start making loans, and then they fund the loans by borrowing off the line of credit to fund the mortgage loan. And then a month later, after the loan has been closed, they package it up, they bundle, they sell it off into the secondary mortgage market. And then once they get their money back, then they take that and they pay it back to the line of credit, and thus repeat the cycle. So you have a similar thing going on here, where a private equity or a hedge fund might say, hey, we need a $50 million line of credit because we're making all these loans to small businesses, and we need a way to be able to fund that. The only institutions that have the ability to basically print money are banks. I mean, that's what a banking charter allows you to do. Basically hedge funds, private equity funds, and then you've got the other online lenders such as Block, PayPal. I mean, even Amazon has lent billions of dollars to small businesses at this point. So you have, and then there was a whole bunch of On Deck, Blue Vine, Cabbage, all these other different online lenders. They all fall into this shadow banking category, if you will. But that's why some of these, just to give you an idea of how this works or how this comes together. So, but now let's look at factors behind shadow banking's growth. So there are a few standout reasons why shadow banking has seen the growth it's experienced. So here are some of the factors behind the trend. Technological advancements. So technology has been a major factor in the explosion of shadow banking. New technological capabilities are allowing lenders in the sector to utilize non-traditional lending models and credit scoring metrics, such as assessing mobile payment records to determine a borrower's viability. Lack of regulation. They don't have the regulation that banks have. Increased demand for credit plus greater barriers. So the global demand for credit has surged, especially in regions where traditional banking services are limited or inefficient. So of course, borrowers with a less established credit history or startup businesses may also experience difficulties securing lending from traditional financial institutions. And then finally, you have cost efficiency. So shadow banks often bypass the high compliance costs associated with traditional banking, meaning they don't have to comply with the regulation. And some may not have brick and mortar footprint to pay for, making their services more cost effective. So now, what are the risks of shadow banking to traditional banking. So the increase in shadow lending has caused concern among industry experts who fear that the lack of regulation of the sector means any risks could go without notice and potentially result in a scenario reminiscent of past financial crises, such as the 2008 mortgage crisis or the 2023 collapse of Silicon Valley Bank. So last summer, the Federal Reserve proposed rules that would enable the regulator to collect more comprehensive and granular information about the banking industry's exposure to shadow banks. So U.S. regulators are not alone in their concern. The European Central Bank has been keeping a close eye on shadow banking and warning about the risks such activities could pose to the global financial system since 2021. Concerns about shadow banking include liquidity mismatches and the risk that if investors lose confidence and begin withdrawing significant sums of money, that shadow banks may not be able to fulfill all the requests. This is a particular risk because shadow banks lack access to the liquidity of central banks. And if they fold like Silicon Valley Bank did, it could result in market turbulence and bank runs for consumers and businesses who don't know the difference between shadow banks and insurance-backed institutions. There's also the risk that major failure by a player in the sector, such as a money market or mutual fund, could cause widespread panic among investors. Now, why is this important? Well, I have talked extensively about private credit and the rise of the private credit industry, which is a huge part of shadow banking. And I think, the big concern here is that, you have a lot of hedge funds and private equity that are involved in these private credit market. And right now, as I have explained in other episodes, they have been buying anything and everything out there in sight. They're just gobbling it all up. And it seems like the traditional credit box, if you will, has gone out the window, and they're just literally getting anything and everything they can get their hands on, which usually leads to a credit bubble, which usually leads to the bursting of that credit bubble, which leads to exactly what they're concerned with right here. So now we've established, shadow banking, the factors behind its growth, the risks. So now let's get to why would small businesses choose non-bank lenders over a traditional bank? Well, what are non-bank lenders? What are they doing right now? Well, with low overhead costs and fewer regulatory burdens, it's easy for non-banks to offer businesses good rates on loans. However, it's more than just loan pricing that's driving small businesses to non-bank lenders. CFIs want to compete with non-bank lenders should consider the following perks that are driving lending relationships for their competition. So relationship premiums, repayment schedule flexibility, fewer documentation requirements, and faster loan decisions. So we talked about the lack of compliance and the lack because they don't have to follow the regulations that banks do. Therefore, they are able to offer perhaps payment schedule flexibility in kind of different ways. Fewer documentation requirements. Well, non-bank lenders requiring 78% fewer documents than traditional CFIs, even in cases where the CFI is the loan applicant's primary financial institution and already had some of the documentation they needed. Well, hello, hey, go talk to the FDIC and the Fed and the OCC, go talk to them about that. Relationship premiums is the interesting one. The same research shows that banks sweeten interest rates by an average of basically a quarter point for long-term customers. Non-bank lenders offer an average 1.3% reduction. So if you're reviewing an application for one of your most profitable customers, you can use your data to find the right loan pricing to retain the relationship and keep it profitable. So, okay. Faster loan decisions. We talked about the technology there. Banks required an average of 32 days to approve or deny loan applications. Non-bank lenders needed an average of 7 days. Could you decrease loan decision time by sharing, data across your CFI? Use a single platform to handle loan applications, account management, and payment processing. AI systems can offer a faster look at credit worthiness by looking at a wider data range than traditional loan applications can. Okay. And then we get to partnership. Behavioral analytics and predictive algorithms can help lenders spot good credit risks. Partnering with a bank or a non-bank lender that has these capabilities is one way to quickly acquire them. So, so again, it gets very interesting here, but I want to go back to one thing for just a second, and that is it's more than just loan pricing that's driving small businesses to non-bank lenders. Well, this idea that non-bank lenders offer better interest rates, I think that's a little bit of a fallacy, because I think what people find out is that the technology is great, the turnaround time is great, but then when they then they get hit with a 70% interest rate. And then the repayment terms, yeah, they may be flexible, but they can also be a lot harsher too. I mean, there's instances where you get $100,000 loan and you got to pay that back in 12 months, and they're going to take a hefty chunk out of your account every week, not once a month, every week. They're gonna hit your account for some kind of payment. So again, I think there are pros and cons. I think there's a lot that banks can learn and need to pay attention to about what a lot of these non-banks or what are these non-bank lenders doing in terms of, and they do have some advantages. I mean, the cost of compliance is a big one. The fact that they don't have branches is a big one. But it's not all sunshine and rainbows. Like when you look at some of the Fed studies, you find out that, people like some of the stuff about, what the online lenders or, what's going on in the shadow banking world, so to speak. But people don't trust them as much. People aren't necessarily as happy with them as they are with their traditional bank. But they're there for a reason. If you can't get your loan at a traditional bank, or if you need the loan really quick, and there's some type of loans that banks just don't like to do generally. And they have their place, and and like I said, if you're kind of up against it, you can go out there and you can still, one way or another, you can get your loan. So, but again, this is just really interesting. These two blog posts really went together very nicely. And I really just wanted to point out this rise in shadow banking, what's happening in the shadow banking world. And then also, why are small business customers, why would they choose a non-bank lender over a bank? And I think that, some of the issues there, they can, maybe lower fees, less documentation, faster turnaround time, nicer, technology, make it easier, workflows of getting, all your application information in and out, that kind of thing. So, but very interesting indeed. Big things that we need to keep an eye on. And so, I will continue to report back as we have more information on this particular topic. But with that being said, I will wrap up by saying, if you like this episode, please make sure to like, share, and subscribe, as that really helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. And as always, please check out some of the other content on the channel. I thank you for listening. I hope everyone has a great day out there, and I will see you again real soon. Thanks a lot.